Hi, everyone. Thank you all for joining us this evening. I really appreciate you taking out a little bit of your time to join us so you all can learn how easy it is to become a homeowner in 2021. And we're going to talk about all the great products that we have available for you all to get you to your goals in 2021. And Glenn is going to host. I'm the host, rather, and Glenn is going to take it over. So go ahead.
Well, I'm glad that they're all here. One of the things before we get into tonight's presentation, it'd be interesting for you to kind of maybe to comment for everyone, how fast are houses coming off the shelf and selling? It seems like, they get on the market for like only a couple of days, and then all of a sudden there's like 3 or 4 offers. How difficult or how easy has it been for you to find housing? Once all these people, it seems like there's a lot of people that want to buy a house, want to get pre-approved, and there's just not a lot of inventory. So tonight's seminar is all about how to get pre-approved and how valuable that pre-approval letter is, so that you, Pam, you can take them and help them in the negotiating process, because there's a lot of people out there looking to buy houses these days, correct?
It absolutely is. We do absolutely have a supply and demand problem right now. We have a lot of buyers because the interest rates are very low right now. However, there is not a lot of inventory with the houses. So I've been in several multiple offer situations. I just negotiated 2 and put them under contract. One had 15 bids on it, one had 12 bids on it, and another one had 10 bids on it. So I won 2 out of 3.
Fabulous.
Not too bad.
Well, yeah, that's why tonight is going to be a good educational seminar. I'm on the team Greer, the Pam Greer team. My partner Tony Marino is the branch manager at First Centennial, and we're going to bring you, what Pam and the team have collectively put together to show you how easy it is to become a homeowner. Pam, hasn't it been, at least it's been my experience, that a lot of people think they need to put 20% down payment to buy a house or 10% down. I don't think they realize that they can buy a home for as little as 1% if they use down payment assistance. Would you say that's kind of a true statement?
Absolutely, it is. It absolutely is. I have a couple of my clients that are using the down payment assistance program, and it's worked out really well for them.
Well, great. Well, what I'll do is let me get into tonight's presentation, because I want to bring some really good education that the Greer team has assembled for you. And at the end, we'll give you our contact information if you'd like to go to the next step, and that is have Pam's team get you pre-approved and have Pam start showing you some homes that might be that dream home that you've been wondering about. So let me share. I know that we're recording this. Let me share my screen with you. And by all means, if you don't know, in the lower left corner, there is a mute and an unmute button. Feel free to unmute yourself if we go to a concept that you don't understand and you'd like more comments on it. Please feel free to unmute yourself and raise the question, and we'll discuss it right then and there. So you all are welcome to unmute yourself at any point in time.
And then you can also put questions in the chat box, guys. And then at the end, we'll get to all of those. Or if you have something like Glenn said that you want to talk about at that moment that he goes over, you can just unmute yourselves and ask your question as well, or put it in the chat, whichever one you like to do. So you ready to get started, Glenn?
I am ready. So I'm sharing I'm going to share my screen. And we have over here our wonderful PowerPoint. Let me bring it up from the beginning here. Well, it's Pam Greer, who's our host tonight, and Tony Marino is the branch manager of First Centennial Mortgage. And again, tonight we're trying to present to you how homeownership just got easier. We hope that you'll walk away with at least an understanding of the down payment assistance programs that are available to you, as well as how easy it is to buy a home for as little as 1% of purchase price. Real quickly about me, I'm the business development manager for the Marino team in Naperville for First Centennial Mortgage. I'm a loan originator and a certified public accountant. I specialize in getting people into homes using down payment assistance. I use education to help people understand how they can become homeowners and own a part of the American dream. I married my college sweetheart, for the past 27 years. And we have 3 beautiful daughters. And the key thing here is 2 of the 3 daughters have already bought a home using down payment assistance like Pam was talking about. Well, the American dream. Homeownership is still the American dream, and buying a home can be exciting, yet can be an intimidating process. Again, the Greer team believes that in the American dream, and we feel that most people still do, but are unsure as to whether it's achievable anymore. So many people are, wondering about credit and their debt ratios and student loans. So again, we're going to talk a little bit about how easy it is to become a homeowner tonight. So this homebuyer workshop, we'll present to you with the information that will help you prepare to purchase a home. Why have this workshop? Why has Pam decided that this is really a great educational program? Well, she feels there's a need or a want, for people to become a homeowner, that people don't want to be renters for the rest of their lives, nor do they want to live in their parents' basement. So, I mean, there's too much misinformation. It goes back to that question I started at the very beginning. How much of a down payment do people think they need to save up? And saving up can be quite a task. I mean, 20% of $100,000 is $20,000. I mean, that's not an easy task for someone to save up. And again, 20% is kind of a wives' tale. I mean, I don't see that with the first-time home buyers. I mean, I see more in the 5%, 3.5%, and as little as 1%, as you'll see later on tonight. Why have this workshop? Well, it's to improve your knowledge of the home buying process and home ownership concerns. Why have this workshop? Well, we want to set aside individuals' lack of confidence. Some people, they think they're years away from owning a home. Well, Pam and I want to make sure that you realize here and now is a good time to be buying a home. That 50% of the renters think they can't afford the down payment. That could be true in the conventional sense, but when you go through this workshop here, you're going to see that you can get up to $10,000 in down payment assistance from the Greer team. That gets people really excited. That gets people moving. Well, maybe I should look into getting myself pre-approved if you can get me $10,000. However, they have the financial means to maintain. They have the ability to maintain a mortgage payment. Because a lot of times the mortgage payment is about equal to what they're paying in rent. If you can make a rental payment, you typically can then make the mortgage payment. Why this workshop? Because we're going to educate individuals on the financial assistance available to them for a home purchase. We want to enhance the quality of life. I mean, again, when you see what buying real estate does to your net worth long-term, you're going to say, not only do I want to buy a home for my family, I might want to buy a second home. I might want to buy a rental property with Pam's assistance. So we're going to help individuals with wealth building and equity appreciation. Fancy term for, we're going to help you understand the home buying process so that you feel comfortable not only buying that primary residence, but that you might dip your toe into buying in rental properties in the future. And that's going to help build your net worth and help to make you financially independent. Who is this workshop good for? Well, it's good for renters. Let's stop renting. If you keep paying rent to someone, you're not building equity in an asset. You're building the landlord's equity. He's loving you. But rent, it's good for renters. It's good for existing homeowners. Because again, existing homeowners are finding that, hey, it was great to be living in downtown Chicago. I was single, I was near restaurants, I was near all the good nightclubs. It was a fun place to live. But then all of a sudden I met the girl of my dreams or the guy of my dreams. And all of a sudden, we had children, and all of a sudden that 1-bedroom condo in downtown Chicago got a little small. There were toys everywhere. there was no, I tried to work, from home, and I had, I was stepping over, squeaky toys. So they leave the condo market and they want to go buy a single family residence with Pam's help. And they find that maybe they're not getting enough equity out of that condo. They're not getting enough net sales proceeds for the down payment on that single family residence in the suburbs. Well, again, tonight, this seminar that you're on is not only good for first time home buyers, but it's good for existing homeowners also. You are not precluded from being able to participate in the down payment assistance program. Who's this workshop good for? It's good for sons, daughters, and millennials. Again, I own a home. I own a second home. I've owned rental property. But my daughters haven't. So as soon as they graduated from school and they had a job, I said, are you going to continue to rent and build a landlord's equity? Or are you going to buy a home and I'll help you with down payment assistance and show you how to get into housing? Family members, it's good for family members that dream of home ownership. It's good for friends. Everybody on this call has a friend. And when you guys get done thinking about why is this good for me? Why shouldn't I be part of the American dream? You're going to start telling your friends, and you tell them about Pam Greer, and that she's the one to go to help them find that dream home. This workshop is good for anyone who thinks they can't buy a home because they did not save enough money. I hear that all the time. Well, I would buy a home, but I just don't have enough money for the down payment. Pam and I are about to show you that you don't have to have a lot of money to be able to buy that dream home. Some of the myths are 45% think you need a very good credit score to get a mortgage today. And again, Pam, what if, when we say a good credit score, I mean, I think a lot of people think it's as high as like 780 or 750 that they need for a credit score, right?
Right. That's what they think, but that's absolutely wrong.
I mean, we can go as low as, on the down payment assistance program, we can go as low as 640. There's a lot of people who are renters who have 640 or better credit scores. Yeah. Green light. So far, you're halfway there getting down payment assistance. So again, they think they need a credit score of 780. 35% think you need a 20% down payment. The fact is the average down payment is just over 7%. 64% of the millennials have not put down 20%. 36% have not even put down 5%. So that means people, the younger people, are putting less than 5%. They're putting 3.5%. Or if they go with the down payment assistance program, they're putting 1%. And again, let's put that in perspective. Pam, if you showed them a $200,000 home, with 1% is $2,000. Most renters have that 1% that they need for the down payment assistance program because they have a first month's rent, right. Say it's $1,500, and they have a security deposit, another $1,500. They've got $3,000 in the bank. So if they got $3,000 in the bank for that next landlord, they definitely have at least $2,000 for that $200,000 home. And again, if it's a $300,000 home, 1% is $3,000. They got that $3,000. And we're going to show you how you best use that $3,000. And again, 31% of you don't think that you can qualify for a mortgage loan, so you don't even try. And what Pam and I want you to do is try, because it's all free. Try to get yourselves pre-approved. If you have a 640 or better credit score and you make less than $109,200, you got 2 green lights that qualifies you for down payment assistance. So how do you overcome these issues? Well, let Pam be your advisor. Let us be your advisor. We are experts at what we do. Pam will work with you to find you that perfect home. We'll work with you to find you the best down payment assistance program. Right. We'll hold your hand and guide you through every step of the way. And by the way, did I tell you that Pam Greer and Tony Marino, they're really friendly people. They're really nice people. What are the advantages of home ownership? Well, it's a place of your own. You got your own backyard. You got your own place. You take care of your own things. When you own a car, you take care of that car. When you own a home, you take care of it a lot better than you rent a home. So you end up with a stable housing cost. You can't have the landlord saying, well, your rent was $1,200, but now it's going to go up to $1,300, and the next year it's $1,400. You're going to stabilize your housing costs by going into a ownership or purchase situation. You build equity. Remember what Pam was saying at the beginning of this? She said that houses are coming off the shelf like crazy. She's in multiple offers. So what that means is the house that gets listed for $200,000, people are offering $202,000, $205,000, $206,000. They're trying to be the best bidder to get that house. What that's doing is it's driving up the value of real estate. That's called equity. Equity is the difference between what your house is worth and what you owe to the lender. And if the value goes up and the mortgage comes down, the difference is you're building equity that you can realize when you sell that house in the future. Right. So you're gonna get tax deductions on the interest you pay to the lender, and you're gonna get real estate taxes also as a deduction. You can, in the future, you can borrow against that. Remember we said that equity is gonna build up, the house is gonna continue to appreciate year after year, to become more and more valuable. The mortgage is gonna go down and down and down as you pay it down. And the difference being the equity, you can go back to the Greer team, go back to Tony Marino and say, hey, I want to borrow against that equity and I want to buy a rental property. I want Pam to take me out and go look at a rental property. Again, you can borrow against that equity to help build your portfolio. And homeowners versus renters have 45 times greater net worth than renters. So we're encouraging you guys, to get into the housing market, become owners for as little as 1% of the purchase price, and watch your net worth grow year after year. Some more of the advantages of being a homeowner: you're going to stop paying rent to a landlord. You're going to move out of your parents' home. You're going to gain independence. No one's going to have to tell you when you can come in, when you can go. You're going to pay less in income taxes because you're going to be able to deduct the interest expense and the real estate taxes. And once again, you're going to increase your wealth by acquiring an appreciating asset, which you have no asset if you stay a renter. So buying a home is a huge step, but buying a home doesn't have to be confusing nor that challenging, because you got the Greer team behind you. Our program has 3 components. One is the home buyer and home ownership education part of it, the one-on-one counseling that Pam and Tony provide, and the financial assistance that you're going to get also along the way. With the one-on-one counseling, you're going to get a personalized approach for those who need more detailed information to help overcome barriers to home ownership. What do we mean by barriers? Pam and I see all the time where people might have a collection item on their credit report, or they might even gone through bankruptcy, Chapter 13, Chapter 7. The good news is, after 2 years of being in and out of a Chapter 7, you're back into the housing market. Don't let these small barriers keep you from the American dream and from Pam showing you how to buy a home. We're also, the counseling also is going to improve an individual's confidence in their ability to purchase a home. Again, remember, so many people feel, oh, I don't qualify for a home. Let's get you into that pre-approval process. Let's find out what's holding you back. Is it a collection? Is it something that, is it a parking ticket? Is it that you were passed due on a visa bill? Let's find out and how long it will take for your credit score to get at least to the 640 mark. Let's address credit issues and mortgage qualification. It's all free. Again, what Pam and I are always trying to tell people is stop defeating yourself. The process with the Greer team is it's all free. Free to find out what your credit score is, free to find out what the credit barriers are, free to come up with a plan. Tony and Pam will go through the credit report and determine what you need to do. You need to pay that Visa outstanding balance from $999, which you have $1,000 credit, and you're at $999. And Tony and Pam can tell you, hey, if you pay that down to 40% of the credit limit, your credit score can go up by, and they can tell you how many points it'll go up by. So let's address credit issues if any of you think you have credit issues. Let's get advice and recommendations specific to your individual situation. And you're going to get it from a licensed originator and a licensed realtor. Financial assistance, well, it helps an individual overcome the financial barriers to home ownership. Financial assistance is typically what we call down payment assistance. For example, $7,000, it's now as high as well, down payment, in our example is about $7,000 on a $200,000 home. Well, again, most people go, Glenn, Pam, I don't have $7,000. I have $1,500 in a security deposit. I got $1,500 in my first month. I got $3,000 in the bank. And you want me to come up with $7,000? Stop talking crazy talk and just show me a rental. But what we're saying is we're going to show you financial assistance. We're going to show you that Pam can get you up to $10,000 to help you pay for that. You come up with 1%, Pam will come up with the rest of it through down payment assistance. Or if you need closing cost assistance, again, closing costs are typically about $5,000 on most purchase transactions. And again, people say to Pam and Glenn, they say, hey guys, you're not listening. I have $3,000 in the bank. You want me to spend $2,000 of my $3,000 toward the down payment. I got $1,000 left in the bank. And you want me to pay $5,000 in closing costs? Well, the Greer team's here tonight to tell you how they're going to help you pay for those closing costs between down payment assistance and the wonderful negotiating that you're going to get from Pam Greer, where the seller can help pay for some of those closing costs. Your team, Pam Greer and Tony Marino, they can provide you with access to the IDA program, which is known as the Illinois Housing Development Authority, which is going to get you, there's 3 different programs, $6,000, $7,500, or $10,000. Let's get you pre-approved for a home loan for free. We're going to download the what we want to do is we want you to download the FCM Express, which again, if you guys have cell phones, if you guys have either the Play Store or the App Store, search for what's called FCM Express. There's no space between FCM and Express. It's one of the best mortgage calculators out there, because then you'll be able to see the breakdown of your housing payment. You'll be able to put in a purchase price. You'll be able to put in an interest rate, down payment, and you'll be able to calculate the total payment that a lender is going to be asking for you. And I think you're going to be pleasantly surprised that it's not much more than what you're currently paying in rent. So it helps. The lender helps you determine how much you can afford. The lender can help improve your credit score, as we talked about. If you're not at that 640, say you're at 610, say you're at 580. And again, I should make it clear here, we can go all the way down to 580. If you don't need down payment assistance, if you've got the money saved in savings, if you've got a mom, a dad, a brother, a sister, grandma, grandpa, and they're a blood relative, and they're willing to give you a gift to help you with down payment, then you can go as low as 580 and still qualify to purchase a home through the Greer team. But again, we're still going to go through and show you how, with a 640 or better, how you can get up to $10,000 without asking relatives for a gift. And if you want or need additional assistance, you'll get one-on-one counseling from Tony and from Pam. So let's talk a little bit about the home buying process before we get into how you buy it for 1%. So let's kind of like start from the beginning and we'll go to the end to your closing. So what we're going to do is we're going to get you pre-approved first, which means that you'll go to that FCM Express. You'll fill out an online application right on your phone. It takes about 10 minutes. Tony will then acknowledge that you've sent it in. If something is missing, he'll tell you about it. And after you get pre-approved, he sends a copy of your pre-approval to Pam and to you, which gets stapled to any type of an offer that Pam and you make to a seller. So after you get pre-approved, you're going to meet with the realtor to discuss your housing needs. Pam's going to, find out, okay, based upon what you got pre-approved, it's going to tell her, okay, that you can afford a home in the $200,000 range, in the $250,000, in the $300,000 range. Okay, great. You're going to know your income supports that price. You're going to be looking at size. Do you need a 2-bedroom, 3-bedroom, 4-bedroom? Pam's going to be talking about your family situation, the children. Is it multi-generational? Do you have grandma, grandpa? Do you have mom and dad? Do they live with you? Do they plan to live with you? So these are all things that Pam's going to be talking about. Neighborhood. What kind of a neighborhood are you looking for? Are you looking for the city, for the urban? Are you looking for suburban? Are you looking for school districts? Pam can tell you all about school districts and neighborhoods. And again, neighborhood in the sense of maybe you need to commute to downtown Chicago. Maybe your job is in downtown Chicago. Well, you might want to be near a train station. Pam can again look at what neighborhood, how easy is it for you to access the main metro stations to get to downtown Chicago. And last but not least, lifestyle. Are you interested in that downtown urban lifestyle, or are you interested more in the soccer fields and gymnastic fields that you might find, maybe in the suburbs? Again, all part of finding out what your needs are. That's what Pam's a very good listener, effective listener. That's what she does to help make sure that she's showing you the right homes. So once you have talked about what type of a home you're looking for, and you've been pre-approved, Pam's going to take you out. And Pam, what do you typically show them? A half a dozen homes when you're out looking at homes?
Well, typically that's what I would normally do. However, in this market, it may be only 2 or 3 at a time. However, I like to show them at least, 4 or 5 if I can in one day or either in one weekend. So that
And
way.
if they like it, you're probably telling them, make an offer now.
Right away, yes. Because they're not lasting. They're flying off the market like hotcakes.
Gotcha. So like she says, then you're going to make an offer, which is Pam's going to help you fill out the purchase contract. They're going to ask you for earnest money, which is, $1,000, a couple $1,000. And, so now you've made your offer. So you get pre-approved, you meet with Pam. She finds out what you're looking for, what your family needs. You make an offer and you tender earnest money. Then once your contract is approved, is accepted, sellers accepted, you make offers as a buyer, sellers accept them. And again, that's not an easy bridge there these days, because again, a lot of these sellers are waiting for many offers to come in. But if you like a home, you make an offer that day, because tomorrow that home may be gone. Absolutely. Once it is accepted though, once you are the successful bidder, once your contract has been accepted by the seller, Pam can help you select an attorney. If you already have an attorney, great. But again, Pam has multiple attorneys that she deals with, and she can help you select an attorney. What they'll do then is you're going to perform your due diligence. What is due diligence? Well, you don't know enough about the house. You're going to hire, Pam has multiple home inspectors that she likes, that she trusts, that they're professionals. They're going to walk through it and look at the electrical. Is the fuse box up to code? It's going to look at the hot water heaters. How old are they? Are they showing any signs of leakage? What about the furnace? What about the air conditioning system? They're going to look at all your mechanicals. They're going to be looking for mold. They're going to be looking for a lot of things to make sure that what you're buying is not a lemon. And if there are issues, they will give you a report, a home inspection report, and then Pam and your attorney will negotiate with the sellers saying, we want these items fixed prior to closing. How do you know they're fixed? Because lovely Pam will walk you through the day before your closing or the day of your closing, walk you through and make sure if they said they were going to fix these 8 things, boom, 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 you're going to be walking around with Pamela making sure that those things were fixed. Otherwise, we're on the phones back to the seller saying, excuse me, you might have to give us a credit because you forgot to fix 2 of the items. So again, part of the process is after you go to contract, you have a period of time. You have an attorney review, which typically is like up to 10 business days. And then you have a home inspection, which is typically about 5 business days to get those done. Because again, if the home inspection shows that this thing is got mold and it's, the roof is leaking and the foundation is cracked, you're going, wait a minute, I don't think I want to buy this house. Pam can, Pam and the attorney can then get you out of the contract, and your earnest money is returned to you, no questions asked. So you're going to send your, once you've done the home inspection, once you've done the radon inspection, you're going to send your executed contract and your loan docs to the Greer team, to Tony Marino. The loan goes through what's called processing. Processing is a fancy term for auditing. You said on your application you made $5,000 a month in income. Well, someone's going to audit that. They're going to verify it. that it says that you have a car payment that you make $210 a month car payment. Someone's going to audit that via credit report, making sure that it's $210. You said you had $3,000 in the bank. Someone's going to audit that. They're going to ask for a bank statement for you to show that you got $3,000 in a bank statement. So the loan goes through processing. They order an appraisal. They order verifications of your employment. You said you're employed. You said you make $5,000. We want to make sure that yesterday you didn't get fired. We want to make sure that you're employed and that you're going to continue to get $5,000 every month. Once it's been verified, once it's been audited, quote unquote, once it's been processed, it's going to go to underwriting. Underwriting are those people that, they look at all the documentation. They make sure that your debt ratios are within guidelines, that you're putting down the necessary down payment, that everything's verified to their satisfaction. And they do three things. They approve your loan. Hey, congratulations, you've been approved. They decline your loan. They say, nope, we decline this loan. You don't have the credit score. Or, nope, your income was calculated wrong. You don't make $5,000 a month. You only make $3,000 a month. And therefore, we can't approve this loan. Last but not least, they can suspend the loan. So suspense means, hey, I don't really understand everything that's in this file, but I'm giving you another chance to make it good. Go get me a document that shows you got $3,000 in the bank, or help me understand your income. It's coming from two different sources. You got two jobs. Help me understand it a little bit better. So again, the Greer team, Tony Marino, Pam Greer, they're going to help you with any of those suspense type items to convince the underwriter to approve your loan. So once it goes to underwriting and you got rid of the suspense and you're moving forward, you're going to get what's called a conditional approval. Conditional approval typically means, hey, I need an additional pay stub. Hey, I need an updated bank statement. Your bank statement was less than 30 days from closing. They always want documentation to be current in the file. So if your closing is more than 30 days away when it comes out of underwriting, they're going to ask you for an updated bank statement. They're going to ask you for an updated pay stub. So that's what conditional approval is. Conditional approval is saying, hey, I need some updated documents. And then once they get those updated documents, they're going to get a clear to close. And then you're going to get a call from the Greer team, from our head processor, Blanca Flores, and she's going to tell you how much cash to bring to closing. You're going to have a pretty good idea from Tony Marino how much cash you should, but the actual dollar amount is going to come from, once you get clear to close, they will tell you, hey, congratulations, you're clear to close. We don't need any more documents. And here's the dollar amount you need to go to the bank and bring to the closing. It's called a cashier's check, and you're going to make it payable to yourself, and you're going to endorse it over to the title company at the closing. So at the closing, you're going to be either at a title company or an attorney's office. Pretty easy. I'll tell you, what office to go to. You're going to sign documents, probably about 25 to 30 different documents. There's a note, there's a mortgage, then there's all these federal disclosures, all these state disclosures. And so you're going to sign many of the documents to make the home yours. The lender cares a lot about the note. The note is your promise to pay them back. And the mortgage is their lien on the property while you use their money. What does the seller get? The seller gets a check. They were selling the house for $200,000. They get the money that you just borrowed from your lender plus your down payment. In other words, the seller gets a check, you get a house, you get a deed. The buyer receives keys and you move in, and we have a big smile on your face, and Team Greer is very happy for you. So why don't most people buy a home? Well, a lot of them say I don't have enough money saved. You said you needed about $7,000 for down payment. Well, we're here to tell you that that's a wives' tale. You don't need, all the money doesn't have to be your own. It can be down payment assistance. Some people say my credit's not good enough. I don't have a 780 score. Well, we're here to tell you 640 is a great score because you get $10,000 in down payment assistance. Or if you don't need down payment, 580 is a good score. We'll still get you into a house. And then again, why don't most people buy a home? Because they just don't think they can buy. They're convinced that they're just not ready. They're not eligible. And we're here to tell you, try it. It just might be fun because again, it doesn't cost you anything. Do the things in life that are free. If you can get yourself pre-approved for free, do it. If given the chance, would you like to stop renting? If given the chance, would you like to move, but don't have a lot of equity in your current home to give enough of a down payment on the next home? If given the chance, would you like to keep your assets invested? Some people have their money in the stock market. They think the stock market's doing great, and they don't want to liquidate it for a down payment or for closing costs. No problem. We can get you $10,000 in down payment assistance. If given the chance, would you buy a home for as little as 1% of the purchase price? I tell you, I've been in this business long enough where when I poll 1,000 people, 999 people have no idea that there's down payment assistance up to $10,000, and they have no idea that they can buy a house for as little as 1% of the purchase price. So I always feel good when I'm able to educate them and say, well, now what's stopping you from becoming a homeowner? So let's talk about some of the exciting loan programs. Well, if you were a veteran on this call, we have 100% VA loans. And I'm not going to go through all of these, but I want you to know that if you're a veteran, you can do 100% financing. What we want to focus on tonight is the $6,000, the $7,500, and the $10,000 IDA, Illinois Housing Development Authority, access programs. Because the first one, the $6,000 one, is a forgivable grant. So let's think about it. A grant, they grant you the money. It's not a loan. And then they forgive it over 5 years. So that means if you stay in the house for 5 years, you don't have to give them back the $6,000. Call that a great day. The $7,500 program under the Illinois Housing Development Authority is a zero interest loan. I call it the crazy great program. Why is it crazy great? Because they give you $7,500. There's no interest on it. Listen to this next statement. And there's no payments for 30 years. So you're going to give me $7,500. You're not going to charge me interest, and you're not going to send me a bill for monthly payments. So when do I pay that back? Well, at the end of 30 years, because I'm only going to, I want the money back at the end of 30 years, or when you sell the house. So if you only stay in this house for 10 years before you move up and buy a bigger house, that's when you have to pay back the $7,500 out of sales proceeds. Well, what a great deal is that? I get to use the money to pay for my down payment and my closing costs. I don't have to make any payments. And if I stay in the house for 10, 15, 20 years, I only have to pay back $7,500 out of net sales proceeds. Crazy great to me. Where was that when I was trying to buy a home? Last but not least, $10,000 program. It is still a zero interest loan. It's the only one that requires a monthly payment. Remember, the $6,000 was a grant. There's no payments on a grant. The $7,500 was no payments until you sell the house. But the $10,000 one, zero interest, but they want principal paid back over a 10-year period. 12 months in a year times 10 years, that's 120 payments. If you divide 120 into $10,000, that's $83.33 a month. So I always ask, Pam asks, we ask our clients, hey, what would it cost you to take your significant other out for a nice dinner? Glass of wine, nice meal. They always say, well, it depends on the restaurant we go to. It could be $60, $80, $100. Could you give up one of those meals a month? Such you got $83.33. We'll give you $10,000 if you'll at least reserve $83.33 to pay it back every month. They go, done deal. Give me $10,000. Let's go look for a house. So that's as hard as it is on those down payment assistance programs. You need a 640 or better credit score, which a lot of people have. And if you don't, the Greer team can help get you there. The second thing is you need to make less than $109,200. Pam, tell everyone, a majority of my clients make less than $109,200. How about your clients?
Yes.
Absolutely. I mean, it's for everyone. And it's not only certain counties, it's everywhere in the state of Illinois. So it's anywhere, make less than $109,200 and have a 640 or better score. Sounds like green light to me. So here they are again, just a little different format. This is the $6,000 program that is Well, it used to be forgivable over 10 years, but go to the far right-hand side. It is now forgivable over 5 years, this $6,000 program. The 7,500 is zero interest loan due at maturity. Maturity is when in 30 years or when you sell a house. And the $10,000 program is $83.33 per month of principal payment. Okay, so these are the exciting new loan programs: $6,000, $7,500, $10,000. I would, if I was in your shoes, I would want to know whether I qualify for that. Can you get me $10,000 so I can go out and become a homeowner? Because the two biggest things that have been holding anybody back from becoming a homeowner is A, I didn't save enough money for the down payment, and two, my credit score isn't at least 580 or 640. Well, we're here tonight to say, well, then let's work on your credit and let's get you to 640, because as soon as you get to 640, you make less than 109, Pam can get you $10,000. So let's look at some of the eligibility requirements. Some of it you've already heard already. The down payment assistance program, which is good for down payment and closing costs, are good for first time and non-first time home buyers. So you don't have to be just a renter. You could own an existing home. You must purchase a 1 or a 2 unit property. 3 and 4 unit buildings do not qualify for down payment. But I want you to keep in the back of your mind, 2 unit, 2 unit. 2 units are pretty exciting to me, because that means that you live in one of the units and you have a tenant renting the second unit. And if that tenant, if your mortgage payment, let's say, is $1,600 a month, and your tenant's paying $1,000 a month to live in the second unit, $1,000 from $1,600 is $600. That means your payment is $600 a month to live in a 2 unit building. I kind of like that idea. And if you can get $10,000 from the state of Illinois to help you with the down payment and the closing costs, I think that's a real possibility. Now, again, not everybody wants to have a tenant in their building. That's fine. But for those of you that would like to really reduce your mortgage or your monthly payment, look at those 2 units with Pam. The borrower must occupy it as your primary residence. Primary means that's where you live. It can't be a rental property. You can rent the second unit, but you must live in the first unit. There's no non-occupant co-borrowers allowed. What does that mean? Mom and dad want to help you out. They want to use their credit. They want to use their income to help you. They're not going to live in the property. That's called a non-occupant. Mom and dad are non-occupying the property. But under the down payment assistance program, they will not allow non-occupant co-borrowers, okay? So mom and dad can't be co-borrowers with you. You can do it's only a 30-year fixed rate loan. You can do a VA loan, an FHA loan, a USDA loan, or a conventional. Most people are doing FHA loans because the required down payment is only 3.5%. You come up with 1%, and the IDA program pays the other 2.5% using your $10,000. The income and property limits, we'll take a look at that in a minute. We just said the income limit is $109,200. I'm here to tell you that covers a lot of people. And what's really important here on the income limit for a second is that it is a borrower limit, not a household limit. What do I mean by that? Household, there is a husband, there's a wife, and the husband makes $90,000 and the wife makes $100,000. The two combined are $190,000. In the old days, it was a household limit. $190,000 is greater than $109,200. And you don't qualify for down payment assistance. However, if you took the wife who makes $100,000, and if she on her income alone can qualify to buy that $300,000 home, we don't need the husband's income. We take him off the application as a borrower. We just use the borrower's income. $100,000 from the wife is less than $109,200. Ding, 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 we got green lights. She can get down payment assistance. The husband can still be on title. We're not going to, we're not going to make him go away altogether. He can still be owner. He's just not a borrower. And he can still get down payment assistance. How great is that? Again, minimum credit score is 640 and 640 for any type of a loan. The debt ratio cannot exceed 45%. What do I mean by debt ratio? In a ratio, there's a numerator and a denominator. In the bottom portion, the denominator is your gross income. Remember I said you make $5,000 a month. It is not your net take-home pay. It's not after Fed, FICA, and state of being withheld. I want to know the gross amount that goes into the monthly amount that goes into your denominator. In the numerator is your, I'm sorry, in the denominator is your gross income. In the numerator, it's what is your housing payment, which again, if you got FCM Express on your phone, you can calculate that. Again, it's going to be about $1,700. Then we're going to add to it your minimum payments on credit cards, your minimum payment on student loans, your car loan, any type of monthly minimum debt obligation goes into the numerator. We want your debts as a percent of your gross income to be less than 45%, which is very doable. And then if you get green lights, you got a 640 or better credit score, you make less than 109,200. The only other obligation you have is the borrower must contribute 1% of the purchase price. Well, I'm all up for that. Pam's showing me a $200,000 home, and 1% is $2,000. Okay, that's less than my first month's rent and security deposit. I'm more than happy to give her $2,000. Or I want to buy a $300,000 home. My income supports it. That's $3,000. So again, you guys must come up with 1% of the purchase price or $1,000, whichever is greater. Typically 1% of the purchase price is the greater number. And you'll have to go to homeownership counseling. You can do that online. Team Greer will give you the link. They'll give you the HTTPS. You go there, you run through the counseling session, and it's good stuff. It talks about budgeting and helping make sure that you've got the necessary funds every month to make your mortgage payment. IDA, Illinois Housing Development Authority, their interest rates. There's only one interest rate. The cool thing is, don't get confused. If you go for down payment assistance, it's not like, well, let's go shopping. Let's see if we can get a lower rate. There is only one rate in the whole state of Illinois. Every morning at 9:30 a.m., the Greer team gets the IDA rate. The state says, here's the rate for the day. If you were to call in, and not every lender, by the way, is an IDA certified lender. Right. The Greer team has IDA certified lender in the form of Tony Marino. So there's one interest rate. You can't get any better. You can't get any worse. I'm going to show you what the rate is on the next slide in a minute. The interest rate is the rate for the borrower's first mortgage. Because again, let's say you're going to do a $200,000 purchase. Okay. The down payment typically is $7,000 on an FHA loan transaction. So that means you're really borrowing about $193,000. That's your first mortgage. These down payment assistance, the $6,000, the $7,500, and the $10,000, those are second mortgages. They're going to be put onto your property or lien on your property. So again, the rate that we talk about here, it's going to be in the low 3%. That's what it will be on your $193,000 loan. Remember, on the other ones, there's zero interest loans. There's no interest on them. And all you got to do is pay principal on that $10,000 and you pay nothing on the $7,500. The IDA down payment assistance is a second lien on your property with only the $10,000 program requiring any monthly payment of $83.33. So here's today's interest rates. Remember, the $10,000 program is this one that's called repayable. Look at the rate. On a government, which is FHA, it's 3.125. I remember when I was first buying my house, I was paying like 8% on my first home. You guys are in the marketplace. What a great time to be buyers. 3.125%. It's amazing.
It is.
And then here's again, let's take a look at income limitation. We're in Cook, DuPage, Kane, Lake, McHenry, and Will. It says $109,200. Okay, cool. And then if you come down here to what is the maximum purchase limit? Well, it's $326,781. Round numbers, $327,000. Pam, I don't know of many first-time home buyers that are out there saying, hey, I want to buy a home for greater than $327,000.
Right.
What do you say?
Yeah, most of mine are below 300,000. Yeah, most of
Absolutely.
them
So, I mean,
are right at 300,000.
for most of you that are on this line, on this call today, I mean, as long as you're not buying a home for more than 327,000, you got green lights, and as long as you make less than 109,200, you got a green light.
Mm-hmm.
So let's take a look at a real quick example. We call it the 3 buckets of cash at the Greer team. What's that? The first thing says purchase price $200,000. Down payment can be 3%, 3.5%, or 5%. Let's go with the middle one. That's an FHA. That's 3.5%. That's another assumption. The IDA program. Remember we said 10,000, 7,500, and 6,000. Let's go for all the money. Let's go for the 10,000. The average closing costs we said are about 5,000. And if you use down payment assistance, IDA wants an origination fee equal to 1% of the purchase price. So they want 2,000. So those are our assumptions. So let's go to the rent first. By the way, this worksheet is available through the Greer team so that you can get it and you can study it and you can explain it to your spouse, to your mom, to your dad, to your brother, to your sister. Because when you leave this, you say, I just was on a seminar with the Greer team and they said I could buy a home for 1%. They're all gonna go, what? You can't buy a house for 1%. Well, we're about to show you how you can. So let's first do the rent. If you stay a renter, your landlord wants the first month's rent of $1,500, wants a security deposit, wants $3,000. Most renters, they got it. In fact, I know they've got it because they got to be prepared that the landlord says, hey, you've been a noisy tenant. Hey, I don't want you in my building anymore. They're ready to move. Secondly, renters have it because maybe the neighborhood's changing. Maybe their children are getting older. Maybe they want to place them in school. Maybe they don't want to stay in their neighborhood. So they're ready to move. They've got the down payment. They got the security deposit in the first month's rent. So now let's see how we use that in a purchase. And we call it the 3 buckets of cash. Bucket 1 is down payment. Bucket 2 is closing costs. And bucket 3 is prepaids, escrows. So let's go back to bucket 1. You told me that you were going to buy a $200,000 home and put 3.5% down. Well, 3.5% of $200,000 is $7,000. Well, immediately people go, Glenn, Pam, you guys are crazy. You're not listening. I don't have $7,000 for down payment. I got $3,000. Show me a rental. But then we come right back and say, but who pays that? If you got to come up with 1%, remember if you had the 640 or better score, you make less than 109, you got to come up with 1%. So you're going to come up with $2,000, the amount in yellow here. You need 7, so you've got $10,000 sitting in this down payment assistance bucket. Take 5,000 out. Now you got 5,000 from IDA, 2,000 of your own money. 5 and 2 is 7. Put a check mark. You got all the money for down payment. Cool, great. Move on to the next bucket, closing costs. Remember we said the average closing costs are about 5,000 and that IDA wants another 2,000. 5 and 2 is $7,000 is your closing costs. Once again, people say to Pam and Glenn, what are you guys talking about? I don't have $7,000. You just took 2,000 of my 3,000 for the down payment. I got $1,000 left in my bank account and you want 7 grand? And so what we're about here to tell you is that, well, wait a minute, you still got $5,000 left in your IDA bucket. You only used $5,000 from IDA in your down payment bucket. So 5,000 remaining, take that 5 and put it into that IDA is going to pay $5,000 of your 7,000. And then the good news here is you're with a great realtor called Pam Greer, who she's going to negotiate for you that the seller will pay $2,000 in your closing costs. So 5 and 2 is 7,000. You've come up with no money for the closing costs. Put a check mark there. You got all the funds that you need for your closing costs. Let's go to bucket number 3, escrows. Escrows are deposits you make with a lender to pay for future expenses that are going to come up in your house. What the lender wants to make sure is that your real estate taxes are always paid, and they want to make sure that your homeowner's insurance premium is paid in the event that there's a fire or damage, that there's insurance to rebuild it and put their collateral back together. Okay. What's the good news here? The good news is that in the state of Illinois, when you own real estate, the real estate taxes are owed a year. We're a year behind in paying our real estate taxes. What does that mean? We're in the year 2021. We're not going to get a tax bill for the taxes due in 2021 until 2022. So if Pam and you have a closing on May 31st, 2021, who lived in the house for the first 5 months? Seller. Seller has to give you a credit at the closing for 5 months worth of real estate taxes that are going to come due in 2022. So you, the buyer, you're going to get a credit for 5 months worth of real estate taxes. The good news is the credit from the seller is always greater than what the lender will ask you to put up in an escrow. Escrow is a fancy term for deposit with them at the closing so much money to help pay your future taxes and your homeowner's insurance premium. So let's go back in reverse. If on escrows, you're coming up with 0 because the seller's going to give you a real estate tax credit. On closing costs, you're coming up with 0 because Ida and the seller, through Pam Greer's negotiations, are coming up with all the funds. On bucket 1 down payment, you're coming up with $2,000 and Ida's coming up with $5,000. So those of you with a calculator, take it out, and you add 2,000 to 0 equals $2,000. So the question that Pam and I have for you all tonight is, would you rather give $3,000 to a landlord in his first month's rent and security deposit, or would you rather put $2,000 of your own funds into buying a home that you call your own? If you say you'd rather rent, we want to talk to you after this class. So no, I'm sure that most of you would like to be purchasing a home. So here's the question. What if the earnest money that you remember, we had to give a contract, and when you give the contract, you have to give good faith money, earnest money. What if you gave them 1% of the purchase price? You're buying that $200,000 home, so you gave them $2,000 in earnest money with your contract. How much cash would you then have to bring to the closing? The answer is 0. Because you already gave your 1% up front when you made your purchase offer, and therefore you will get credit for that 1% that you were already given when you go to your closing some 60 days later. So what's really cool is when the processor, you call them and say, well, great, I'm clear to close. How much money do I have to bring to closing? And she says, well, you don't have to bring any money to closing. You're going to give applause. I kind of like that. Let's do it again.
Absolutely.
So here real quickly, here's a $300,000. I just want to give you guys an example of $300,000. What if we didn't buy a $200,000, we bought a $300,000 home? Because remember, we can go up to $327,000, right? So at a $300,000 home, still doing 3.5% is the down payment. $10,000 is the down payment assistance we're going to use. $5,000 is the closing costs, and Ida wants 1% of 300,000 or $3,000. So we still have the same $3,000 to the landlord, or the bucket number 1 down payment, 3.5% of 300,000 is $10,500. Who pays it? You, the borrower. You got to come up with 1%. You got to come up with $3,000. Cool, get it, 1%. Now there's $10,000. Take $7,500 out of it. 7,500 and 3,000 is $10,500. Boom, put a check mark. You got all the money for the bucket 1. Bucket 2, closing costs. Okay, if I use $7,500 of my $10,000 in bucket 1, I still have $2,500 still. So Ida's going to, for closing costs, who pays the $8,000? Ida can come up with $2,500. The seller can come up with $5,500 through the negotiations with your realtor, the wonderful Pam Greer. So again, $5,500 and $2,500 is $8,000. You got all the money for closing costs, put a check mark, you're on your way toward buying a home. Last but not least, the escrows, same philosophy. You're going to get a credit from the seller for the number of months that the seller lived in the house, and the credit is always greater than what the lender is going to ask you to deposit for future real estate taxes and homeowners insurance at the closing. So 0 for escrows, 0 for closing costs, and $3,000 for bucket number 1 for down payment. That's $3,000. Would you rather give $3,000 and buy a home through the Greer team, or would you rather give $3,000 to a landlord and own nothing? I think we know the answer. So what is your housing payment on a $200,000 home? Well, if you used the FCM Express app, if you downloaded it, you could put in a $200,000 home, say it's an FHA purchase, and it would tell you that your principal and interest is about $828. The down payment assistance, remember we said it's $83.33 a month if you use the $10,000. Your real estate taxes are about $417. Pam can help you when she looks at housing for you, she'll be able to give you a multiple listing sheet and it'll show you the amount of the taxes. Your homeowner's insurance is $75 a month to protect it against fire and damage. And then there's something called private mortgage insurance, PMI. It's accident insurance. If you don't put that, remember we talked in the beginning, 20% down payment, which people don't put down, which means that lenders will give you their money. They'll borrow you the money if you put 20% down. But if you don't, they want private mortgage insurance. So if you put 15% down, 10% down, 5% down, 3.5% down, the less you put down, the higher your private mortgage insurance is. So in this case, this example, and again, that FCM Express calculator will calculate it for you, is $135. So on a $200,000 home, your monthly mortgage payment is $1,455. Well, in our example, wasn't our renter paying $1,500 in first month's rent? This is less than their rent. And now they're a homeowner. And again, this assumes a 3% interest rate. It would be slightly higher because when I showed you the rates, the rate was 3.125. So this might be as high as $1,500. But still, would you rather give $1,500 a month to a landlord? Would you rather give $1,500 to a lender and own your home?
$1,500.
And what if it's a 2-flat? Now you can subtract the rent that the tenant gives you against your $1,500 a month payment. And again, let's be wild and crazy. You've got a $1,500 a month payment to the lender, but you got a tenant that's paying you $800 a month. Well, 800 from 15, that means you only have to come up with $700 every month. I love that idea. I got lots of friends who said, well, this is perfect. I'm gonna go look for a 2-unit, live in one of the units, and keep my mortgage payment really, really low. And I still got more disposable income to go decorate, to go travel, to take vacations, to pay for kids' schooling and all this great stuff. So again, here's an example of a 2-unit. I won't bore you necessarily with it, but bottom line is that the payment is $1,417 a month. They're only coming at, the purchase price was $189,900. The borrower came up with $1,899, so 1%, right? Remember the 1%. So they're buying a 2-flat for round numbers $1,900. Their monthly mortgage payment was $1,400. This number down here at the bottom. And then the tenant was paying them $800 and some a month. So they were only coming up with $592 a month in a mortgage payment, and they only had to come up with $1,899 to purchase it. Who would want that? It sounds great. So let's summarize the 3 buckets of cash. Bucket number 1, down payment. Who pays? Always ask yourself, who pays? We know the gross amount, but who pays it? You or Ida can pay it. It's 3% down on conventional loans with higher score. It's 5% with lower credit scores. It's only 3.5% if you do an FHA loan, with scores down to 580. But if you only want to come up with 1% out of your own pocket, your share, that's how much you're going to have to come up with if you use the IDA down payment assistance program with the 10,000, the 7,500, or the 6,000. Remember bucket number 2, closing costs. We will give you a detailed breakdown of all the different costs that come up to the sum total of 5,000. And remember, there's an additional 1% fee if you use IDA funds. But who pays it? Well, you can pay if you have it. IDA can pay, which we know we love that $10,000 bucket because there's always money left over for closing costs. Number 3, your realtor can negotiate to have the seller pay. Remember that wonderful realtor called Pam Greer? She's a great negotiator. She can help have the seller help pay your closing costs. The seller will either outright agree to pay the closing costs. Yeah, I'm willing to pay $2,500 toward I want my house sold, so great. Or Pam's going to ask them to pay. She's going to ask you, the buyer, ask you guys on this call, your offer for that $200,000 home. If the seller's kind of wishy-washy, doesn't really want to do that, pay your closing costs, Pam's going to say, make an offer for $205,000. Increase your offer by $5,000, provided that the seller pays $5,000 of your closing costs. So if the table of expectation was that the seller wanted to get $200,000, but didn't want to pay closing costs, so if you now offer $205,000, and the seller says, and then I just have to pay $5,000 of closing costs, $5,000 from 205 is $200,000. The seller is still happy with that transaction, provided you first got the table of expectation set and established up front as to what the buyers and sellers would agree with each other. Last but not least, your lender can pay your closing costs by giving you a higher interest rate. Remember the interest rate was 3.125? If you don't use IDA, because remember, IDA only has one interest rate. Can't go higher, can't go lower. One interest rate every day that's published. But if you say, I don't need IDA, I don't need the down payment, I'm good, I got the money. Well then, again, if you need it, however, you're good, you got the money for the down payment, but you don't have the money for the closing costs, the lender can raise that interest rate up from 3.125 to 3.25 to 3.5 to 3.625. And the higher that they raise the rate, the more the bucket of what's called a lender credit, or the greater is the amount the lender can give to you to help pay your closing costs. So in order to get the closing cost assistance from a seller, you must first set the table of expectation. That is the price agreed between a willing buyer and a willing seller. This is where Pam does her magic. She's looking at properties. We're going to ask the realtor to help look at homes with motivated sellers. Maybe it's a home that hasn't been on the market for only a day. Maybe it's been on the market for several months. That seller is motivated. Homes that have had at least one price reduction or has had many days on the market is also a home where sellers will participate in paying closing costs for the buyer. A motivated seller sells for less. A motivated seller allows you to gross up the price from $200,000 to $205,000, and that they will then participate in paying your closing costs. Offer the seller a higher adjusted price by the amount of the closing costs. If the table of expectation was $200,000, offer $205,000, provided the seller will pay $5,000 of the buyer's closing costs. The only caveat here is that your wonderful realtor, that Pam Greer, that wonderful woman that she is, she has to check with other homes in the area through her multiple listing to make sure that the home will appraise out for $205,000. Remember, we were buying a $200,000 home, but you offered $205,000. Well, Pam can tell you that's a good strategy. Let's offer them $205,000, provided they pay us $5,000 in our closing costs. And I see other homes in the area that are selling for or have been listed for $205,000. it's likely that you're going to get an appraisal for that amount. What are people's reaction to grossing up the purchase price by the amount of the closing cost, by grossing it up 5,000? Well, the seller's still very happy. They're still receiving their table of expectation at 200,000. What's the realtor's reaction? They're very happy. They're getting a commission on a bigger purchase price, not 200, but 205,000. What's your reaction, the buyer's reaction? You're very happy because how much of your own money was used for closing costs? Nothing, zero. Because Ida and the seller, through Pam's negotiations, has gotten you all your closing costs paid for. Bucket number 3, in summary, we always have to add is escrows. Escrows for real estate taxes, escrows for homeowners insurance. Again, fancy term for deposits you will put up with your lender. But who pays that? Well, there's something called prepaid interest where you're going to pay interest from the date of your closing to the end of the month. Again, you're smart, you're wonderful realtor, Pam Greer. Most of her contracts have closings toward the end of the month. So what do I mean by that? April 30th, there's a lot of closings that go on the 27th, the 28th, the 29th, and 30th. Because again, if you close on the last day of the month, you're only paying interest from the date of the closing to the end of the month. That's 1 day's worth of interest. I'd rather pay 1 day's worth of interest than 30 days worth of interest. Therefore, most purchases are done at the end of the month. Your escrows, you're going to put 2 months worth of homeowners insurance and anywhere from 2 to 8 months worth of real estate taxes into the escrow. Let's just get to the point here. The seller's credit for real estate taxes while the seller lived in the home will always offset this 2 months of homeowners, 2 to 8 months worth of real estate taxes that the lender is going to ask you for. So in this bucket, who pays? The seller's real estate tax credit pays for all of it. Very cool. So in summarizing those 3 buckets of cash, how much of your own funds did you use? In bucket 1, you used 1% because that's what Ida says. You got to come up with 1% if they give you that 10,000, 7,500, 6,000. Bucket 2 is 0 because Ida and your wonderful realtor, Pam Greer, got it down to 0. And bucket 3 is 0 because of the seller credit for real estate taxes. So what are you waiting for? Why are you not taking action? Or are you going to take action because now you're educated? Are you going to give Pam Greer that call? Are you going to send her that text? Are you going to send her an email that says, Pam, get me started for the big cost of 0. I want to get pre-approved for free. So again, now that you've reviewed how little cash is needed, how do you meet the 3 C's of lending? Well, credit, we said 580, you just can't get down payment assistance. But if you get to a 640, we got 10,000, 7,500, or 6,000. And remember, talk to Pam. If you think your credit score is not 640, let her team pull your credit for free and give you an action plan that says, go pay down this Visa card, go pay off this credit card, go pay this collection or this parking ticket off, and watch your credit score rise. The other C is cash flow or your gross monthly income. Under the down payment assistance program, it cannot exceed 45% of your gross income. So your monthly debts as a percent of your gross monthly income can't be more than 45%. It can be as high as 50% on a conventional loan or 55% for an FHA without down payment assistance. Down payment assistance, 45%. Without down payment assistance, your monthly debts can be as high as 55% of your gross income on an FHA loan. Credit score, let's talk about credit for a little bit. Credit's obtained from any one of the 3 national repositories, Experian, TransUnion, and Equifax. Lenders take the middle score. They don't add them up and divide by 3. They kick out the high, they kick out the low, and the middle score is what they use to qualify you. So when Pam and I say 640, that means your high gets kicked out, your low, whatever your middle score is. And typically in Illinois, that's the TransUnion score. So if you know what your TransUnion score is, you know it's greater than 640, you got a green light, you're headed toward down payment assistance. Your score can be from 0 to 850. You need at least a 580 with no down payment assistance, a 640 with down payment assistance. Now that you have the credit score, let's look at cash flow. You're going to add your housing payment. How do you find out your housing payment? You went to FCM Express in your app store and you downloaded it. And now you can calculate your mortgage payment anytime, anywhere. And as Pam is sending you beautiful pictures of homes that might fit your family's needs, you can calculate your monthly mortgage payment. So you're going to add your mortgage payment to your minimum payment on credit cards, car loans, student loans, and other debts. That's your monthly debts. Those monthly debts, as a percent of your gross income, we said can't exceed 45% on down payment assistance. Again, if you download FCM Express, you can calculate your payment. It will show you the principal and the interest, homeowners, real estate taxes, private mortgage insurance, flood insurance, and you can even, if you're buying a condo or a townhouse, there's typically what they call association dues. You got to pay for somebody shoveling the sidewalks with all the snow we've had. You got to have somebody that's, trimming the bushes and planting the tulips. So the FCM Express will calculate your housing payment for you. What does my housing payment consist of? Well, after you download FCM Express, we saw before, principal and interest, the second mortgage, $83 for the $10,000 down payment assistance, taxes, homeowners insurance, private mortgage insurance. It's all $1,455. How do you calculate your gross income? It depends upon how you get paid. If you're on salary, we take your salary and we can basically, we know your annual salary, we'll divide it by 12. If you're hourly, we'll take your hourly rate, $20.15 an hour, times 2,080 hours in a year. That's 40 hours a week, times 52 weeks in a year. That's 2,080. We'll take your hourly rate. Once we know what you can make for the year, we'll divide that by 12. That's your gross monthly base salary. If you're subject to bonus, we take the last 2 years as an average. If you're on commission, you can make a base plus commission. We will take your commissions that you've earned for the last 2 years and average them. If you're on overtime, I work 40 hours, but I've been working 50, 60-hour weeks at my job. Well, you get paid your base pay for the 40 and you get overtime for anything over 40. We will take your overtime and we will average it over the last 2 years and give you that benefit to help you get qualified for a mortgage. If you're self-employed, if you say, I own my own business, cool. We will take the net income, not the gross, the net. So if all of a sudden I had a golf pro, for example, that said, I'm self-employed, I do golf lessons. Cool. Say he made $70,000 a year in revenue. And I asked him, show me your tax returns. Well, he did make 70 gross, but he wrote off $40,000 worth of entertainment and golf clubs and balls and all. He netted 30,000 because 40,000 from 70,000 is 30,000. The house he thought he was going to qualify for at 70,000, he didn't qualify for at 30,000. So yeah, we will take the self-employed is any partnership, corporation, or business that you own more than 25% of. We want the tax returns for the last 2 years. We'll comb through them. We'll pull out your income. We'll tell you how much income is in those in your self-employed business. A good rule of thumb is again, for walking around purposes, for Pam, for me, for Tony, we usually say combine your gross income and multiply by 4. So an example is a husband makes 40,000, the wife makes 30. That's 70,000 times 4. That means that they can typically qualify to buy a $280,000 home. So again, I should always say that's the max loan, not the purchase price. If they still had money for down payment, they could buy something greater. But that's a good walking around tool. It is not how we approve loans, though. Make sure you understand that. It's good for talking, but it's not how we go back to that 45% rule. Your monthly debts as a percent of your gross monthly income can't be more than 45%. The lender's rules are more precise. They use debt ratios to qualify you. Remember, the housing ratio is the monthly amount you're going to spend on housing that you get from FCM Express. as a percent of your gross monthly income, and your debt ratio, which is the monthly housing payment plus all of the consumer debt, credit cards, car loans, student loans, as a percent of your gross monthly income, 45% with down payment assistance, up to 55% without down payment assistance. So let's see if we answered all these common questions. How much of a down payment do I need? Well, 1% of your own funds, and as little as 3.5% in total, but you can come up with one and I can come up with the other 2.5. How much savings do I need in the bank? Nothing. You need enough for your 1%. How good does my credit need to be? If you've been paying attention, it was 580 without down payment assistance. It's 640 if you want down payment assistance. What is a fixed versus adjustable? We didn't even go into adjustable rates. Nobody's taking adjustable rates. Rates are so low that Pam and I would have to have, so we'd have to put you into a headlock if you took an adjustable rate. Everybody takes a fixed rate with these rates as low as they are. What does my housing payment consist of? We answered that. With FCM Express, you can calculate the principal and the interest, the real estate taxes, homeowners insurance, private mortgage insurance, homeowner association dues. All of that can be found with your new calculator called FCM Express. What are closing costs? We said they're $5,000 in most purchase transactions and another 1% of the purchase price that IDA wants if you use their funds. What are escrows? They're deposits. They're your money that you deposit with a lender to help you pay future real estate taxes and homeowners insurance. And how much loan do I qualify for? 45% of your gross monthly income. So your goal, your homework. You just didn't stay here just to listen to Pam and I. You got homework to do. So what should you do next before you buy a home? Call Pam. No, I mean, you will call Pam, but you're also going to get yourself pre-approved for free. Use that FCM Express. Obtain a free credit report. Pam Greer, Tony Marino, they're going to get you a free credit report. Let's see if you have a 640 or better score. If you need to work on it, let's work on it. It doesn't cost you anything to work on it. Assemble the necessary documents for a full application. 2 pay stubs, your last 2 W-2s, and your last 2 tax returns. That's all it's needed. You're going to get an automated underwriting approval. A pre-approval letter is issued. It goes to Pam and Tony, and it goes to you. Tony will issue it and send it to both of you. That's your ticket to go shopping. Pam's going to gas up the car and say, when should I come get you? Now that you have a yes to your loan request, go find a home with that rock star, Pam Greer. Review an action plan with your mortgage consultant and realtor. You know, if things change along the way, you got 2 great professionals in the form of Tony Marino and Pam Greer. This is your mortgage application checklist. Just remember the first 3 are all you need to get pre-approved. 2 years of tax returns, 2 years of W-2s, and 2 recent pay stubs. So it's 1 dream, 1 home, and 1% down. Let's go get that house. It's achievable. It's within your reach. Congratulations. This all sounds good. Again, what are you waiting for? You're on your way toward home ownership. Find out if you qualify for $10,000. Find out if you have a 640 or better score. You know if you make less than $109,200. Let's see if you can buy a home for as little as 1% of the purchase price. And with that, I open it up for questions, and my wonderful partner, Pam Greer, take over and let them know how they can get a hold of you.
Okay. Thank you guys so much for taking up the time to attend with us tonight. We really appreciate it. I hope you all learned a lot. That's our goal tonight. And I'm going to check and see if there's any questions in the chat real quick, and then we'll get to you all's questions as well.
There's 23 of them. I think we have a few.
This was deep
Okay.
earlier.
Don't you hear you or him? Okay. Okay, we'll do.
She's got an 850 credit score, so she's ready. And then we had a question that was from D earlier.
Okay,
Thank you. Thank you for the compliments. You know, I take good care of my clients. Thank you so much.
she's awesome. See, people know about you already.
Yeah. Okay, so Erica Washington, she had a question. She wanted to know the loan can't be over 320,000, correct? And Erica, the correct answer for that is it can be up to 327,000.
That is correct.
Yeah.
Just shy of 327.
Right.
Absolutely. So, I mean, there is no stopping you if you're buying a home under 327,000, you owe it to yourself to make sure you get in contact with Pam Greer and her team.
Absolutely. And then guys, if you all want to come off of mute, or either you want to put your questions, any questions you have in the chat, or you all can come off of mute and then we can answer any questions that you all have tonight. Thank you so much for attending, Desiree, Leslie, Tina, Raquel, Darkita. Thank you guys. Do you guys have any questions? Type in the chat if you have questions, yes or no. Let's see, Darkita.
Desiree says no problem. No questions from her.
Okay, no questions, Darkita. Anybody? Tina, you have any questions? Leslie? Raquel, you have any questions?
Leslie says no questions. You guys were informative.
Oh, thank you so much. Okay, not at the moment. Tina, you have any questions?
No, I didn't have any questions. It was pretty informative. Thank you guys.
Okay, you're welcome. Thank you so much for coming out and attending with us tonight. We really appreciate it. And if you all think of any other questions that you all may have, please feel free to contact me at 815-545-5825. Again, that's 815-545-5825. I would be happy to answer any questions that you all have. If you all are thinking about getting pre-approved, I can answer any questions about that, and then also send you over the app straight to your phone, or either I can send that to your email and we can get you pre-approved within 24 hours. So once you have that pre-approved in your hand, then basically we're ready to go shopping for your dream home. So whatever you all need, I'm here and ready to serve you all. So all you have to do is pick up the phone and call me, and we can get started anytime that you all are ready. And I
think Leslie has a question.
Oh, okay. Here we go. Okay, Leslie has a question. She says, actually, yes, I have one. Okay. For the taxes, if you started as a 1099, what if you transitions to a W-2 the same year? I think that was one.
Well, what if you start out as a 1099? That means you're an independent contractor. That means that you would be filling out a Schedule C. Right. But then you transitioned to a W-2 employee
in the same year.
In the same year, we would just use the most. Think of it as a pay increase. Let's say somebody was making $20 an hour, and now they're making $22 an hour. You're now a W-2 employee. You're full time. We would just look to see that you got 2 paychecks. When you're an independent contractor, they're not withholding Fed, FICA, and state. When you're an employee, the pay stubs will show Fed, FICA, and state withholding. That's evidence that you're now an employee. We will not go back then and average the last 2 years' tax returns when you were an independent contractor, a 1099 contractor. We will just look at your current salary position, whether it's salary or whether it's hourly. We're just going to look to see that you're working 40 hours a week and apply your most recent hourly rate and qualify it based on what you're currently making as a W-2 employee.
Correct. Did that answer your question, Leslie?
big yes from Leslie.
All right, great. Thanks for that question. And guys, if we don't have any more questions, or if you want to ask me anything offline, again, just contact me. Most of you all have my number, but I'll just tell you again, it's 815-545-5825. I'm here to assist you with all your real estate needs. If you all are ready to get pre-approved, please don't hesitate to contact me. You only need the last 30 days of your check stubs, and then we'll just need your W-2 as well. So other than that, if you're self-employed, we'll need your tax returns as well. So other than that, it's a very simple process that we go through to get you pre-approved. You just give those 2 forms of information and we can get you pre-approved right away. And then we can have a conversation about further about your needs as far as where you want to live and things of that nature. And then we can get started shopping right away. So the housing market, it is really hot right now, as we were talking about earlier, and we have a ton of buyers right now. So yeah, we have a lot of buyers and we don't have that many homes, but I negotiate with all of my clients and on their offers to make sure that I'm winning their bids. So I will work hard for you all to get you all your dream home. So just reach out and we can get started. And thank you so much. I really appreciate you all taking out the time to come out and spend a little bit of your Thursday evening with us. And yeah, we're here and we're ready to assist you all. Thank you.